Have you ever felt like the big players on Wall Street know something you don't? Like there's a secret calendar of events they're all watching, while the rest of us are just guessing. Well, today we're pulling back the curtain on something huge that could be on the horizon, a potential stock market shakeup in 2026. Now, before you think this is another doom and gloom prediction, stick with me. This isn't about fear, it's about being prepared and empowered. So, what's the big deal about 2026? It's not just a random year. A massive piece of legislation, the Tax Cuts and Jobs Act of 2017, is set to expire at the end of 2025. This isn't just some minor tax tweak. We're talking about major changes to individual income tax rates, the standard deduction, child tax credits, and, crucially, corporate tax rates. Remember when the corporate tax rate was slashed from 35% down to 21%? That was a huge boost for company profits and, by extension, their stock prices. Think about it. Lower taxes mean companies keep more of their earnings. They can use that extra cash to reinvest in the business, buy back their own stock, which pushes the price up, or pay out bigger dividends to shareholders. All of this makes a company look more attractive to investors, driving the market higher. For the past several years, this low-tax environment has been a powerful tailwind for the stock market. But what happens when that wind changes direction? If these tax cuts are allowed to expire, corporate tax rates could jump back up. Suddenly, companies would have less money on their balance sheets. Earnings reports wouldn't look as rosy, and the very foundation that has supported high stock valuations could start to wobble. This isn't some conspiracy theory, it's simple math. A significant increase in corporate taxes would likely put downward pressure on stock prices across the board. The market, which always tries to look ahead, won't wait until January 1st, 2026 to react. We could start seeing the effects much earlier as investors begin to price in this potential change. Now, I know what you're thinking. Will the government really let this happen? That's the billion-dollar question. It's going to be a massive political battle. Extending the cuts will be expensive, and there will be intense debate about who benefits and who pays. The uncertainty alone can create volatility in the market. As we get closer to the deadline, every news headline about the negotiations could send stocks swinging. This isn't a market crash that will come out of nowhere. The warning signs are already there, written into law. It's a known event on the calendar. So, what can you do? First, don't panic. The key is to be aware and strategic. Review your portfolio. Are you heavily concentrated in stocks that are highly sensitive to corporate profits? Maybe it's a good time to diversify. Look into different asset classes, like bonds or commodities, that might perform differently in a changing tax environment. Consider industries that might be more resilient. Most importantly, have a plan. Knowing about this potential event in 2026 gives you a head start. You have time to learn, to adjust, and to position yourself not just to protect your wealth, but to potentially find opportunities in the volatility. This is the kind of information the big financial institutions are already planning for. Now you are too. It's about moving from being a passive investor to an informed one. If you found this helpful and want to stay ahead of the curve on major market events, make sure to subscribe and hit that notification bell. Thanks for watching, and let's get prepared together.